Imagine this. It's a normal Monday morning on Wall Street. Traders are sipping their coffee, markets are calm, and then within seconds, everything collapses. Billions vanish, stocks nosedive, and the only system that saw it coming wasn't human. It was an AI, quietly scanning millions of data points, whispering the same warning over and over. The crash is coming. So, can artificial intelligence really predict the next financial meltdown before it happens? Or is the system too chaotic for even machines to understand? Let's find out. Throughout history, financial crashes have hit humanity like unpredictable storms. The Great Depression of 1929, the dot-com bubble in 2000, the housing crisis in 2008, and the pandemic shock in 2020. Each time, experts said the same thing. Nobody saw it coming. But what if that excuse won't work anymore? Today, artificial intelligence is watching everything. Stock movements, credit transactions, global news, even the tone of political speeches. AI models process in seconds what would take economists a lifetime to understand. The question is no longer, can we predict a crash? It's, what happens when AI predicts one and no one listens? 1. The birth of predictive finance. Let's start with how we got here. For decades, economists relied on models built by humans, based on logic, trends, and assumptions. But financial markets are not logical. They're emotional, chaotic, and often driven by fear and greed. Enter AI. With access to massive real-time data sets, stock trades, news sentiment, global shipping data, and even social media chatter, AI can now see patterns invisible to the human eye. Machine learning algorithms can detect subtle signals, like unusual credit card spending, unusual trading volume, or even weather changes that might disrupt global supply chains. By connecting these signals, AI doesn't just understand what's happening now, it starts to anticipate what might happen next. 2. The algorithms that watch the world. Right now, some of the world's biggest hedge funds are using AI systems with one goal: predict volatility before it hits. Take Renaissance Technologies, Citadel, and Bridgewater Associates, firms that have invested billions in machine learning research. Their AIs constantly monitor hundreds of millions of financial indicators: price swings, inflation metrics, consumer confidence, and global liquidity flow. But that's not all. Modern predictive AIs use natural language processing to scan news headlines, social media posts, and even government statements. They assign sentiment scores to every piece of information, measuring whether global emotion is trending toward optimism or fear. In other words, AI isn't just watching numbers, it's reading the mood of the planet. And when that mood shifts rapidly, from confidence to panic, the AI raises a red flag. 3. The 2008 clues. Could AI have seen it coming? Let's rewind to the 2008 financial crisis. Millions lost their homes. Banks collapsed, trillions were wiped out. All because of hidden risks buried in mortgage-backed securities. At the time, even top economists failed to see the storm. But if today's AI systems existed back then, they might have noticed something unusual. AI could have detected a spike in mortgage defaults months before the crash. Unusual correlations between real estate prices and credit growth. Subtle sentiment drops in financial news that hinted at fear. All these signals were there, but buried under noise. Humans ignored them. AI wouldn't have. In fact, some AI models, when trained retrospectively on pre-2008 data, do identify warning signs well before the collapse. It suggests that if AI had been watching then, the financial world might have had a fighting chance. 4. How AI actually predicts crashes. So how does it work in real time? AI doesn't predict crashes like fortune tellers. It works through anomaly detection, spotting when something looks off compared to normal behavior. For example, if market volatility spikes but trading volume doesn't, if investors start moving assets to gold or bonds unusually early, if a global shipping slowdown begins before official reports come out. I recognize these as early tremors of instability. Deep learning models like long short-term memory, LSTM networks, can process years of data to detect patterns that lead up to crises, even subtle signals like liquidity dry-ups or credit squeezes. Some systems even use multi-agent simulations, letting thousands of virtual AIs trade with each other to test how panic spreads through markets. The results are eerily realistic. When fear spikes in one corner of the simulated market, it spreads, just like it does in real life. 5. The problem. Predicting is one thing, preventing is another. But here's where it gets tricky. Even if AI predicts a financial crash, what can humans do about it? If an AI warns that markets will collapse next month, do we trust it? Do we sell everything and trigger the very panic we were trying to avoid? This is called the paradox of prediction. If people believe the forecast, their reaction can make it come true. AI may become so powerful that its warnings themselves could cause self-fulfilling crises. Imagine an AI model used by top investors suddenly flashing red. Systemic collapse risk, 98%. Within hours, everyone sells, and the crash happens because the AI said so. In the future, managing the information that AI produces may become just as important as managing money itself. 6. When AI gets it wrong. Of course, AI isn't perfect. Markets are influenced by human psychology, government policy, war, and random global events. Even the best AI systems struggle with black swan events. Rare, unpredictable shocks that don't fit historical patterns. Think about COVID-19. Most predictive models didn't see it coming. Not because they weren't smart enough, but because they'd never seen anything like it before. AI can analyze the past, but it can't truly imagine the future. That's still a uniquely human skill, for now. 7. AI, high-speed trading, and flash crashes. Here's something even more fascinating and dangerous. AI isn't just predicting markets anymore, it's moving them. Around 70% of all stock trades today are executed by algorithms, many driven by machine learning. They make decisions in microseconds, buying and selling before a human can blink. But this creates a problem. If multiple AIs detect the same risk at the same time, they could all react instantly, triggering massive sell-offs. This already happened in 2010 during the flash crash, when the Dow Jones plunged 1,000 points in minutes before bouncing back. Nobody fully understood why, but algorithms were involved. In the future, an AI prediction could unintentionally cause the crash it was warning about. 8. The rise of financial sentinels. To prevent this, new AI systems called financial sentinels are being developed. Their job isn't just to trade, it's to protect markets. They monitor global activity for signs of manipulation, panic, or fraud, and can alert regulators instantly. In some cases, they can even trigger automatic circuit breakers to pause trading before chaos spreads. Imagine a global network of AIs working together, watching for instability, balancing the system like a digital nervous system for the economy. By 2035, that could become reality. Financial markets won't just be watched by humans. They'll be guarded by intelligent machines. 9. The new role of humans. So, where do humans fit into this? In the AI-powered financial world, human roles will shift from analysts to strategists. AI will handle the data, humans will handle the judgment. We'll need ethicists, regulators, and economic philosophers to decide, should AI act on a crash prediction? Who has access to these warnings, and what happens if AI is wrong? Finance will become less about greed and more about governance. Because when AI knows the future, someone must decide what to do with that knowledge. So, can AI predict the next financial crash? Maybe not with perfect accuracy, but it's getting close. Closer than any economist, any trader, or any government ever has. But prediction alone isn't enough. The real question is, will we listen to the warnings when they come, or repeat history by ignoring the machines we built. Because the next big crash might not come from greed or politics or panic. It might come from an AI that was too smart for its own good.